Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video is all about another subscribe or request video. This time there's three brothers who have asked me different times to look at this company, and that's exactly what we're going to do. I'm going to give you a little bit of information about the company. I am going to tell you the financial details of this company. I'm going to give you the valuations, the performance against the S&P 500 over the last 10 years plus. We will then I'll then tell you exactly what I would be doing with this company, as I do not own it yet, and it has been on my watch list for a very long time. So stay until the end of the video to find out exactly what I will be doing, inshallah, moving forward with this company. And of course, if you have not joined us in the Patreon account, please do so. It really makes a huge difference. And I have now managed to actually apart from, I think I've got one more subscriber portfolio reviews to do this week, and yeah, that's it. So if you guys have not sent me your portfolios, then join us here. Okay, it will cost you what, £6 a month, and exactly genuinely helps the channel so much. And of course, you can get access to the subscriber portfolio reviews. You can send me your portfolios. I can give you a constructive feedback, inshallah, that can help you in the long run, just my honest opinion. And then of course you get access to the family portfolio. You get access to a lot of other things, including 30 companies that are dividend growth companies, high yield companies that I've shared with the community recently, and there's a lot more to come, inshallah. So if you can join us, that would be absolutely amazing. The company we're going to talk about today is called ServiceNow. This is one of the companies that has been on my radar for quite some time. A year to date is down about 9%, which is very interesting. When you look at the rest of the S&P 500 and how it's performing, this company has not done as well. Now, talking about the S&P 500, let's quickly switch things to the S&P 500 itself. A year to date, we are doing really well. Things has completely rebounded. Remember, not long ago, we were actually, if I go back to a year to date, there was a time where this portfolio actually went basically in the red, but we just bounced back quickly. It wasn't that much, by the way, but we came back again, and look at it right now where we are. So basically things have quickly changed. If you look at it over the last 3 months, 3 months, you can see over £10,000 in gains, which is absolutely ridiculous. But we are just getting to where we were just before all that madness has happened. Now, one thing that's happening basically this week is the fact that there are a lot of companies reporting. So the ones that I'm keeping an eye on is West Management, which is a very interesting company that I really like and been keeping an eye on for quite some time. We've got Visa reporting. We've got companies like Bookings, for example, reporting, which I'm not really interested. Procter & Gamble and Merck are basically two companies, and UPS. UPS is one I'm planning to do a video, because there's a lot of brothers who've actually asked me to look into this one again, and is probably one of the worst company that I've invested in for quite some time, and hasn't done anything, and I'm not planning to sell anytime soon. But I will let you guys know a bit more about the company and after they report on Tuesday. But as you can see, we've got Procter & Gamble, we've got UPS, as I said, we've got Merck as well, Visa on that day, and then on the following day we've got companies like Qualcomm reporting, Lam Research, which will be very interesting to see, and then we've got the big boys, Meta and Microsoft. These companies can easily move the market, and again, another one that has not done well basically for me for quite some time, but it has rebounded for quite well over the last few weeks, is Hershey. So I'm keeping an eye on what they say about the prices of cocoa and things like that, how the margins are looking at this point in time. And Qualcomm is an interesting one. This is one that I think they will do well, but I just want to see what else they've got, because right now I was planning to trim it, because there's another company that I'm really interested in that's down quite a bit recently. So maybe I might take some money off the table when it comes to Qualcomm, but I'll let you guys know. Again, we've got MasterCard coming up as well. So there is a lot of companies reporting in there basically next week. So it will be very interesting. This itself, the fact that there's so many companies reporting, especially some of the big boys, can easily change the market. So let's keep an eye on that. And again, as usual, I'm just going to invest the usual amount that I always invest, which is £250 a week. And that's exactly what I'm going to do, inshallah. And yeah, let's see And again, just looking at the fear and greed index, basically, you can see here we are heading towards that extreme greed. So just be careful. Meme stocks are back. Quite a few people have messaged me saying, "Oh, what do you think about this one? What do you think about this one?" I'm not getting into that madness. So it's entirely up to you guys. You know what I think about these, these things. Anyway, let's look at this company today. Service basically now is very similar to, in terms of how you can read it about what they do and so on, but very, very similar to Salesforce in terms of things that they do, including the AI platform for digital transformation and machine learning, robotic processing. They've got all the, basically keywords that you can think of, and they have reported recently. So this is one of the reasons why maybe a few brothers were looking at this company. They have reported on the 23rd of July. And if you look at this, in fact, if we just go back here, I just want to see the actual, there we go. This is it. So they beat bottom line, top line and bottom line, both of them. And as you can see, everything else basically seems fine. When it comes to subscription revenue, it basically is growing, representing about 22% year-over-year growth. Current remaining performance obligations, which is basically, because it's a subscription-based company, that's basically one of the things they measure. Again, head in the right direction. So everything you look at for this company, basically it is heading in the right direction. And in fact, if we just look at the earnings side of things, if we go back here while we are this thing, let me just show you the expectation when it comes to earnings from this company. For by this end of this year, they're expecting about 21%, then 19%, 21%, 17%, and so on when it comes to revenue and EPS. And look at how many analysts are looking at this company, which is quite interesting. Same thing for more or less when it comes to revenue, about 20%, 18%, 20%. So whenever you look at this company, it is very interesting. So right now, the couple of things I want to look at is earnings per share from less than $1, half a dollar, to right now $18 per share. So it has actually gone massively over the last basically 10 years. When you look at the free cash flow per share, it's also heading the right direction. When it comes to shares outstanding, unfortunately, they're not buying back their own shares. They have diluted quite a bit over the last whatever years. So it's interesting to see if it's this because they are growing still. I will give them a chance, but maybe in a year or so, I would expect it just like to do exactly what Salesforce has done. Salesforce was diluting our shares up until about 2 years ago, and then they started buying back their own shares. So this will probably do exactly the same. And again, when it comes to total sales, it's also heading the right direction. A couple of things I want to show you from the total sales side of things. As you can see here, this is basically how much money they are making in terms of revenue. Look at the cost of that and look at the gross profit. These are very high profitable businesses, which is quite nice to see. And when we look at the net income after they've done all of that, is $1.66 billion. In terms of liability side of things, because that's something important to us as a long-term investors, if we just to focus on the total assets, which is about $22 billion, against total liabilities, which is about 11. So total liabilities is about $11 billion and $22 billion when it comes to total assets. So for that reason, there's absolutely nothing to worry about from this company. So revenue is growing, EPS is growing. In terms of net income, it has excellent net income. Everything looks good in terms of the business side of things. A couple of other things that we can look at. Return on equity is slightly basically growing about 17%. Return on invested capital about 10%. Operating margins of 14%. And free cash flow margin, which is really good, about 32%, which is nice to see. Debt levels are almost non-existent. So absolutely amazing. So what we would now want to see, so we've now seen a bit of information about the company. We've seen the financials. It looks healthy. Is it a buy right now? That's the next question we need to ask. And the first thing we're going to do is look at it, basically Refinitiv, for example, and they're saying it's about 17% upside from where we are. $1,135 per share is where they think the price should be. And that's basically so they've got the high, they've got middle, and they got the low, and they average that out, and that's basically how they came about with that price. Now, if we look at tip ranks, for example, as you can see here, $1,148 per share is where they think the price should be. That's about 19% upside from where we are, and it's also a strong buy. We've got 29 buys, 3 holds, and 1 sell. If we go back to, for example, here, you will also see it's a strong buy, more or less similar. 34 basically strong buys, 7 buys, 5 holds and 1 strong sell, and their price tag is $1,143 per share, which is basically what we're seeing here, quite similar to this. Now if we look at again Morningstar valuation, as you can see, is just over $1,000, so it's slightly basically lower than basically higher than where we are right now. So that's why it's 3 stars right now. And as you can see here, it's got wide moat and capital allocation is exemplary, which is quite nice to see. Now I'm going to look at one other place, that is to use fast graph, and this I found it really fascinating using this thing. Historically, the company, as you can see, has been okay, and then over the last whatever years, it's been overvalued so much. And if we look at the performance against the S&P 500, okay, before I show you the forecast, look at this. Okay, so we're focusing on the maximum here. Over last 10 years, basically, you can see the company has compounded growth rate of basically 32%, let's call it about 33% against that S&P 500 of 15. Let's call it about 15, almost to 14%. So it has actually beaten the S&P 500, which is absolutely amazing. And let's have a look at where moving forward. They don't pay any dividends, so there's no point checking that. If we use the base, the estimates that we're looking at right now, which is basically 2025, we're looking about 21%, 22%, 18%, and 19% of 20% of it. So by 2027, you would be losing about, let's see how much you'll be losing. Okay, about almost 53% of your money. So you would have 10,000 investment, you will have 4,626 pounds or dollars left. But if we use the normal multiple, which I think would be better to use for this company, with of course a margin of safety. What I mean by that is you should always have at least a 10% margin of safety to be on the safe side, if you like. Okay, and if we look at that, you can see here your 10,000 will become $20,244 per. Okay, so it is quite a lot. So is it basically we're expecting to double it in basically 3 years time. That can happen because of the expected growth revenue and basically things like that with the AI boom and so on. But at the same time, you just need to give yourself margin of safety of 10%. So if that was the case, so if we go back here, let me show you one more thing. I really find this fascinating. Look at this. Look in the forecast. So if we use the estimate, which is what we were looking at early, and based on the estimates that we've seen, we've already seen basically you would be losing quite a bit of your money. This is the the interesting part here. So the fair value, okay, the fair value for the stock's about $300 per share. So that's what they're saying right now. That is worth that much. Although this stock is $996 per share, it's worth basically this intrinsically. The future stock price will be in 3 years time will be $460 per share, which means you will be losing quite a bit of your money. Now if we use the 5-year normal multiple, which is what this company has been trading over the last 5 years, if we use that, look at the difference. Okay, right now that's the current price. Fair value they're saying is 1,300, so it's a bit of an upside, and the future stock price, that's why you're doubling your money, will be about basically $2,000. So you're doubling your money in basically 3 years time. So that's basically what they're saying based on that growth rate that the over the last 5 years. But again, you need to, so if that's what they're saying, the fair value for this company is 1,300, and we've seen it here, they're saying is about 1,000. Here they're saying is 1,100 something. So I would definitely say their fair price for this company is about 1,000, let's say 100. So that means it's right now, it is a buy right now. So what would I be doing? My plan plan moving forward for this company, which is the last thing we're going to talk about today, is I've got I'm not going to add it into this portfolio. It's definitely going to be in the family portfolio, and there is another company in the family portfolio that has done absolutely amazing job and up so much. I'm planning to trim that. Okay, and start buying a little bit of this company here and there wherever I get the chance. Wherever I see a drop, I'm just going to add to it, inshallah. So I'm going to start a new position hopefully in the next few weeks, if not months, and I'm going to keep an eye on it. And like I said, I'm going to trim that one to add to this one to basically start position for this one. Anyway, that's what I wanted to share with you guys today. If you're enjoying this type of basically content, please don't forget to join us. It makes huge difference. Again, like I've always said to you guys, it takes a lot of time and effort to put these videos together, so it would be absolutely amazing if you can join us in this journey. Have a wonderful day. Assalamu Alaikum.